Back speaking with Dennison Hambling this morning from Intelligent Monitoring. Dennison, good to see you. Good morning.
Hi, Andrew. How are you?
Hey, good, Dennison. Acquired a couple of interesting new businesses this week within the wider group. Just tell us a bit more about these companies.
Yeah, no, thanks, Andrew. So, look, the two businesses we've acquired, we announced in the last couple of days, ACG Integration and Alarm Assets Group, our WA, really fill in that national coverage we've been seeking to unlock our ADT commercial business. And so when we bought ADT, and as part of our strategy, we've been talking about for some time, we've been wanting to bring ADT commercial back to life. It had essentially been shut down by its prior owners and had been a leading business. It's a very strong sector, very profitable area with a lot of prospect and no leader. And so what we've been doing well. So we've taken the business, restarting it from 2 million sort of a revenue a year up to run rating about 12 by June on our own back. But the key limitation is actually quality people. And so what these acquisitions do, bringing them in, is they give us some scale. They give us some quicker, faster scale that we can then accelerate and build off. And so they're quality businesses. We're very lucky to have been able to pick them up. They're very integratable into what we do, and they will allow us to really look forward into FY25 with confidence around growth. And I think, the comment I would make is that we're, as a stage of life business at the moment, we're now entering growth. And so we've done the platform, the integration work, we've done the turnaround work. We've still got pieces to do in the background, and we're doing that. But what we're focused on is growth, and these are growth acquisitions.
And what will these acquisitions mean in terms of group revenue and earnings?
They add, so we guided our FY24 recently upgraded. I think we had a chat a week or three about that, Andrew. So we're at sort of $33 million, call it EBITDA target for 24. These businesses effectively add just under $6 million of EBITDA to that on a pro forma basis. So, our starting foundation going into FY25 is about the numbers in the print, but a $39 million EBITDA sort of pro forma number. So in terms of scale, it adds about another 20% to answer your question to EBITDA. But as I say, I think the real story, other than they're very accretive, and we're talking about sort of 17%, earnings accretion on a business trading on 5.5 times, PE, is actually the fact that we're really looking for that growth now, and that's the platform we've built is to prove and show genuine organic growth, supplemented at times, but not like all the time by M&A, wherein if we see it as being sensible.
And these purchases funded through a placement. Just tell us a bit about the capital raise.
Yep. So that, look, the placement is we bought these businesses cash basis, 100% equity funded. In both cases, they are founders who are retiring, exiting the industry, who had set up management structures who, as I say, are very integratable. And so we funded that via equity, and incredibly happy with the demand we had, the institutional demand for that placement. Brought in a number of new, what I would genuinely call high quality institutions, which will become apparent, I think, to people shortly. And grateful for both their support and our existing shareholders' support, can continue support through this journey. I think what the other side of these acquisitions, though, is that they do also continue to de-gear us. And whilst that it hasn't been something we've felt we've had to do in advance of a refinance, it certainly is not something that is unhelpful either. So we're now sort of pro forma sub 2 times net debt EBITDA. Our next strategic move is to refinance our debt. We have until February next year paying guaranteed interest, and I don't feel inclined to overpay on interest because we're paying a lot of money already. But by February next year, you should expect the refinance for us as the next major strategic move. And that will be, on our numbers, conservatively, that's about a 30% uplift in NPAT to still come through when we do that. So, we're sitting here today with both a business that we feel really strongly about in terms of where we've got to, really positive about in terms of growth, and also, very, we feel notable in our actual valuation. We're very, very cheap.
And I suppose in terms of, well, just on that, looking forward, do you reckon these acquisitions here will kick things off for you in terms of seeing some real value in your shares?
Yeah. Look, I don't know. I mean, our attitude all the way through is we have to earn everything we do, and and hence an upgrade to us was obviously something we've always wanted to achieve. We'd like to be known as essentially under promises and over deliverers. So I think to a degree I would expect we have to earn things, but certainly from our point of view, yes, we are wanting to show that we've built a platform and growth. And I think the point I'd make about the commercial, just back to these acquisitions themselves, is that and I've said this before, we don't have a demand problem. Like, we're a very lucky industry and we're in a very privileged position, particularly in this day and age and time. But what we do have is a technical based problem. We have a workforce in this industry that is flat to declined, that is in demand, and so therefore, what our real challenge is to attract quality people who will continue to help us unlock, and we absolutely got that with these transactions. These are high quality technical services businesses with fabulous workforce who really want to engage and do more and increasingly interesting pieces of work, and that's exactly what we have in our books and what we have coming down the books at us. So we're really excited by that. It's a great environment to be part of.
Great to speak to you, Dennison. Thanks for your time.
Thank you. Cheers.